Hello and welcome to Investing Confidential. I've got over 100 videos now, and I was going to stop, but I'm going to continue to record videos only because of the great feedback I'm getting from the few loyal listeners I have. I've gotten some private emails. Thank you guys. I appreciate it. It's nice to hear from people that appreciate what you're doing. Someone like me who comes from a different background, and most of these YouTubers that talk about finance, because I really came from finance. I mean, I was in the pits. I was a hedge fund manager, invested in over 30 countries. So I've done it all. And as you can tell, I'm not a typical YouTuber. First, I'm too old. Number one. Second of all, you know, as you can see, I'm not doing this for the money. I'm not asking you people to follow me. I'm not begging for likes, begging for followers. I probably should, but I'm not. I've again, like I said, I've invested in countries all over the world, from Chile to China, and I'm just trying to give my 2 cents of all the knowledge that I've had about, especially about the macro, what's going on, what's really going on in the world is really screwed up right now, especially in the U.S. So I'm just trying to give you some tidbits. I'm going to be traveling to Brazil today. I'm going to probably this week do a lot of Brazil content, because I think Brazil's probably one of the most important countries for the U.S. and the world. But now I'm going to talk to you a little bit about the U.S. and what I think is getting really ugly at this point. I mean, I know I'm fairly negative on these videos, but things are getting really dicey now. And if you've been following, you won't be surprised, because everything is coming away. But first, let me talk about First Republic Bank. First of all, this is a sideshow. Okay, this is a total joke. This is a complete sideshow. And as I go through the rest of this video, you'll understand why. This was a bank for the elite. Okay, First Republic was really a private bank. Okay, their clients were rich people. Okay, they were, again, like I said, mainly a private bank. They had good marketing. They had a good cachet, but they had morons running the bank. Okay, complete morons, not bankers, but morons. Okay, SVP, Signature Bank, now Republic. You guys are seeing the pattern here. All these three banks are gone. Okay, all these three banks service elite, service the rich. Okay, there's a pattern. All right, high net worth people, dumb management. Okay, supposedly sophisticated clients. And the reason they went under is these sophisticated clients, okay, demanded higher returns. Okay, where most of me, yeah, I guess I could be considered elite, but I do my banking with Citibank and J.P. Morgan. I don't do my banking with Republic Bank and Silicon Valley Bank. Okay, and I've suffered through the low returns. Okay, as you know, if you had an account in one of these big banks, they paid you nothing over the last 5 years. Nothing. 10 basis points, literally nothing. And the common person who had money, they got peanuts, absolutely peanuts. But you know what? Your money was safe. And now the tide has turned. Okay, it was okay for a while. Now it isn't anymore. As you can see here, money market inflows are soaring. Okay, absolutely soaring. These banks, all banks, are in trouble. Okay, not the depositors, because, as I said before, don't worry about the banking system. The banking system's fine. Okay, the government will bail you out, whether you have $5 or $50 million in a savings account. You're backed by the government, so don't worry about that. The problem is, don't be a shareholder. Okay, if you're a shareholder of any bank, you're in trouble. All these banks, to offset this money market, are going to have to raise deposit rates. Okay, this is going to hurt profits, what they call the NIM and NIM, net interest margin, the difference between what they pay out deposit and what they take in from loans. Okay, this is why you see here, as you can see here, they've ripped up credit card interest rates. They're skyrocketing. Okay, this is the highest in 35 plus years. If you have a credit card and you have, and there's a lot of you out there who have big deposit credit card, you're getting screwed. Okay, this is terrible for the consumer, especially young people. The statistics I saw, young people have the highest credit card balances outstanding. They're living off credit cards. Okay, finally, another problem with the banks: there's no loan demand. Okay, real loan demand. There's credit card demand, but no loan demand from businesses or from individuals. This is traditional loan. This is not good. Banks can't earn a return, but they're going to have to raise their rates. And what's that's going to do? It's going to hurt profitability. So do not be a shareholder of a bank, folks. until this whole situation straightens out. Okay. Uh, and all of this is just very bad. Okay. The economy is in recession. Okay. I don't care what the numbers tell you. The economy is in recession, has been for a while, and you're really going to see the numbers accelerate. Okay. But before I get too negative, okay, and I always get negative, I want to show you why you shouldn't be too negative after you listen to this video, because we are setting up for another violent bear market rally. Okay, why? It's simple. Here's a chart. Okay, these are the S&P E-mini contracts. Okay, why I showing the E-mini are the most traded stock futures, right? They're most active stock futures. They tell you where people are positioned. Institutions trade them, individuals trade them. They're the most liquid stock futures in the world. Okay, and as you can see here, we are at the most extreme bearish position since 2008. Okay, positioning is everything for a trader. Okay, if you're an investor, I would say stay in cash, but for a trader, you got to be careful to get too bearish because the positioning is against you. Okay, the bears are going to win in the end, but to get really short right now, I probably wouldn't do that again because of watch this positioning. All right, let's start with the data. Okay, this is from the Fed. Okay, fairly reliable data, but again, take it with a grain of salt. Okay, you've got Richmond Fed here, really from the southeastern part of the country. Okay, manufacturing collapsing. Okay, here you also see capacity utilization. Why is this important? Well, capacity utilization is how much of a factory is the car company's using. They're not using much, collapsing. Okay, this data is a disaster. Okay, absolute disaster. Okay, here's Kansas City Fed. Again, same thing, manufacturing crushed. Look at new orders. It's just the beginning of the collapse. Okay, you got Yellen telling people a week ago the economy's strong. You got the White House telling people the economy, going on television saying the economy is in good shape. I mean, these people are in la la land. But more importantly, they're lying to you. Okay, that's the bottom line. GDP came out first quarter, 1% was really a low number. And this is a terrible miss. Okay. Most people are saying now, most Wall Street are finally coming in and saying we're going to have a recession beginning in the second quarter or third quarter. Okay. By the way, this Atlanta GDP now, as you can see here, they're even predicting a slowdown. They're the morons who told you 2% for the first quarter. And now they're predicting a deep slowdown. So what does that tell you? Okay, these are the most bullish guys out there. They're fake and they're bullish, but this is what they're telling you. And here we got the New York Fed predicting a recession. Now, look at this. This is the highest probability the New York Fed has had for a recession since the early 1980s. Yes, much bigger than 2008. Okay, the New York Fed. I mean, it's there. It's clear. Don't listen to any. Look at the data. Okay, and what's contributing to this? Well, it's inventory reductions, meaning businesses. There's no demand. They're carrying high inventory, and now they're reducing. Okay, there's no ordering going on. There's no demand. They're selling down inventory. And how do I confirm this? Well, look here. You got a retail inventory skyrocketing. No one's buying in the stores. So the inventory's building up. Now the retail company is going to have to start it. And what's that going to do? That's going to contribute to second quarter slowdown. There's no consumer demand. Okay. Look at personal savings. Again, this talk about the consumer. People are not saving. They're depleting their savings. They're gone. The consumer is tapped out. Okay. Tapped out. They're levered. There's $1 trillion in consumer credit debt balance. This is a disaster. Okay. And let's go back to small business because this is the lifeblood. This is more information. You folks, you've got to be following this information. Okay. Consumer optimism for small business optimism, consumer optimism, it's falling like a stone. Okay. Why is this important? Well, simply because small business, as I've been saying this for a long time, but here it is in pictures. They are the driver of jobs. 80% of job openings coming from small business, not from the big companies, but from small business. Their optimism of falling. So guess what? The jobs are going to go away. You're going to see, here to here first, unemployment rates skyrocket. So that unemployment rate that's around 3.5, whatever the government says it is, it's going to hockey stick significantly higher over the next 2 to 3 quarters. You heard it here first. Okay. This is obviously not what Wall Street wants to hear, what the White House doesn't want to hear, but this is the reality. Okay. And finally, look, the US government's in deep crap. Okay. You've got this debt ceiling negotiation still ongoing, no negotiation, whatever the hell. It doesn't matter what they're saying. Okay. And I showed you this US CDS, okay, credit default swaps of the US skyrocketing like never before. Okay. People are hedging them. Investors are hedging themselves against a US default. This is a disaster. Okay. And what's this going to mean? It means lower demand for treasury bonds. Why is that important? That means rates are going to stay higher. The treasury bond auctions are going to have to go up, and they're going to keep rates higher for longer. This is not good. Okay. But the real issue here, as you can see here now, okay, look at the government interest expense. Again, this is not, it always goes up, but it's kind of level. Since 2022, it has exploded for obvious reasons. Since the Obama administration, we've been lowering our duration, meaning we're, instead of being our overall debt being 5-7 year duration, we've been going down. Now it's around 2 years. Okay. It got to the lowest. I think it was right around 2 years. And so as these bonds come due in 2022, boom, double the rates. The rates are going up. The rates are going up. So our interest expense is skyrocketing. And just the recent tax revenue came in when taxes were due on the 18th. The preliminary numbers are bad. So we've got increasing interest rate expense and lower revenues. Would you buy a stock like that? I certainly wouldn't. Okay. And let's go back to what I said in the beginning. First Republic is a sideshow. I almost cursed, excuse me. It's a sideshow. Okay. The powers that be, the controlling the media, whatever, they want the Fed to pivot. Not only they want the Fed to cut. Okay, they're done with this. The banking system, the insurance system, they're all technically bankrupt, as I told you before, because they were buying bonds like morons for 5 years at zero rates, and now the rates are up. They never hedged. They're out of business. Okay, so they need the Fed not only to pivot but to cut. So they're going to pound this First Republic, and if it doesn't work, they're going to have another bank's going to come out, or an insurance company. It's going to happen. They're going to force the Fed to make a policy error because inflation is very sticky. So what are we going to have? We're going to have, this is a confirmation of stagflation. Okay, and as an investor, the implication of stagflation is the U.S. dollar. The implications of a dollar are terrible. For what I just said a couple of minutes ago about the interest expense and all that. But here you look, the U.S. is still one of the most expensive currencies in the world. Okay, look at it. This is one of the top 3 or 4 or 5 expensive currencies in the world. For context, here's a big, they call the Big Mac Index. Here's an overview. Okay. There was just an article about how McDonald's wrapped up prices. The demand was down, so they jacked up prices, and they had an artificially good quarter. I'd be selling McDonald's on back of that, because next quarter is going to be terrible, because they've already told you the demand is weak. Okay, so there's room for this U.S. dollar to really fall, and that's not good. Okay, and that is not good. So going forward, as I've been saying, you need to start looking overseas, some Europe. Emerging markets, these are the places you're going to make money, okay, or cash, okay? And to summarize here, recession is here. It's going to be confirmed very soon, okay? Don't get too bearish in the short term, because positioning is against you. As I told you, positioning is against you. Cash is king, and gold is a must-own. So if you're an investor, you got to own cash, you got to own gold, maybe some non-U.S. equities, but be very careful out there.